Hey guys, Credit Shifu here, and today we're going to be looking at President Trump's proposed tax plan. Now I know this is a little bit different to what we normally talk about. It's not credit cards, but it is personal finance, and it is going to affect each and every one of you that pays tax in the United States. I know that about 90% of our audience is in the US, so it's important to know about this stuff. First of all, let's just say I'm sure probably half of our audience loves Trump and the other part probably doesn't like him, as is the state, throughout the country. We're not really getting into politics in this video. It's more just looking about the economic aspects of what's going to happen probably by the end of the year. So first of all, let's just say that the changes to the tax system are basically taking something that is already incredibly unnecessarily complicated and simplifying it into something that's just mediumly unnecessarily complicated, and at the same time giving everyone a bit of a tax cut, but some are getting more tax cuts than others. Now let's jump right into it and have a look. We'll start off with the standard deduction, which is increasing. Now if you don't know, the standard deduction is basically the 0% tax bracket, the first however many $1,000s of your income that are tax-free. And Trump is increasing it from $6,350 up to $12,000, so it's basically doubling. But the personal deduction, which this year is $4,050, that is being scrapped under these proposals. And normally that deduction would be applied to you and every other person in your household. So if you're a single person, your standard deduction is $6,350. Your personal deduction is $1,050. So together it's $10,400 that you don't pay tax on. That's still less than the new standard deduction of $12,000. So that's a good thing. You're getting about a 15% increase on that. And for joint filers, people married filing jointly, it's a $24,000 standard deduction. So it's basically double all those figures. But there are a few other things changing as well. Many itemized deductions are being scrapped, with basically only two left. That's going to be mortgage interest that will be tax-free and charitable donations. So some people who did a lot of itemized deductions probably will lose out a little bit. From the $10,400 up to $12,000, they only have about $1,600 of that tax-free allowance that's supposed to make up for the money they're losing on these itemized deductions. But the thing about it is actually some people probably kind of didn't fully understand all the different stuff that they can deduct anyway, and so they were missing out on these opportunities for itemized deductions anyway. That's definitely something very common, that people don't pay that much attention to their taxes and they miss out little deductions that they could get here and there that would take their taxes down. Let's now look at the tax brackets. So the US currently has 7 tax brackets, and under this policy they're going to be simplified into just 3: 12%, 25%, and 35%. I'm going to show you this chart, which actually comes from Investopedia. I'll give them a little bit of a free ad since I'm using the chart on their website. Basically, if you're interested in investing, saving money, it's a great website to check out, investopedia.com. There's a lot of interesting articles on there. So let's have a look at this chart. Well, the first tax rate for the lowest earners of 10% and the tax rate of 15% are being combined into a 12% rate. Now you'll notice, and I'm going to quote all the figures for the married filing jointly section, because I think that is most common for people who are really paying attention to their taxes. If you're a single filer, you can just look at that column. So for married filing jointly up to $18,650 is paid, you only pay 10% tax on it. That's now going up to 12%, but you will be saving money with a much larger deduction, so it may end up about the same. And the 15% tax rate is now lowered down to 12%, and that's on income up to $75,900. Now, the US annual household income currently is $59,000. So that's the average. So basically, the average household is going to fit in to this 12% tax rate. So actually, if you're in the average level of income, you're most likely going to be getting a tax cut. And if you think about it, bringing it from 15% down to 12%, once you're beyond the standard deduction and any sort of adjustment or missing out from itemized deductions you used to get, as you increase in income, every $1,000 extra you earn, you get to keep $30 extra than you would have done before from that $1,000. So definitely as you increase and get to higher incomes, 50,000, 60,000, etc., you're really going to notice that you're actually getting a tax break. Let's have a look at the next section. 25 and 28% are going to be moved together into a 25% rate. So obviously the people who were paying 28% before, they're getting a tax cut. And 33%, 35%, and 39.6% are going to be merged into a 35% rate. Now, there is one group here that's going to be getting a tax increase, unfortunately, from $233,000 up to $416,000. That used to be taxed at 33%. It's now taxed at 35%. So on that amount of money, from 233 up to 416, they used to pay around $60,000 in tax. They'll now be paying $64,000 in tax on that, around approximately $180-something thousand. So they're paying $4,000 extra on that section of their income. Can't say I'm hugely disappointed. I mean, it is people who have salaries of several $100,000 a year anyway. But, you know, it is kind of worth pointing it out that that is a tax increase, although they may be saving some money somewhere else. So, you know, we'll get to that, a few other things later on that might show that it's not a true tax increase. People who are earning at the 35%, that's staying the same. That's actually a very small bracket anyway. And then above $470,000 a year for joint filers, their tax rate is coming down. And this is pretty substantial because there are a lot of people who earn high incomes that are getting taxed at that 39.6% rate. And, you know, they're going to be... That's actually going to translate, although it's a small percentage-wise increase, it's going to translate into a huge monetary tax decrease. So the top 0.1% actually contribute around 30% of the tax revenue, and the top 1% together contribute about 55% of the tax revenue. So when you consider it that way, these people will be paying a lot less. So guys, I'll tell you what I think about this a little bit later on. Let's now look at business taxes. And Trump is doing something which I really like here. He's going to make the maximum tax bracket for LLCs, so LLC partnerships, S corporations, and sole proprietors. Basically, these are businesses that have what they call pass-through income, where you don't pay business tax rates. The profits of the business are passed through onto the personal tax return of the owners, and they just pay them at personal income tax rates. So it avoids the problem of double taxation in small businesses. In a big corporation, the corporation will be first taxed on its profits, and then it pays out dividends to its shareholders or owners, and then they're taxed again as, you know, tax on those dividends, probably payable at long-term capital gains of 20%, or if they've held the shares for less than a year, it would normally be taxed at your personal tax rate. So it's double taxation. But with these small businesses, like people who own stores or who own like certain online companies, myself included in this, I'm a co-owner of a company that owns the Credit Shift YouTube channel and the Generation Tech YouTube channel. We run it as an LLC partnership, so we would be included, except right now we're not earning enough to be in that bracket. We're in the 15% bracket, which is going down to 12%. But it is a bit of an incentive to people who want to increase their business's income, that as they get, you know, reach higher incomes above $233,000 for married filing jointly, they're not going to be hit with a higher rate of tax. Their maximum is 25%. So that is quite an incentive. And I know that part of this plan is that Trump wants to get more people to run their own businesses, encourage the growth of small businesses. Not everyone wants to work for a big evil corporation. Now, the last thing I'm going to talk about is the corporate business tax for larger corporations. That's going down from 35% down to 20%. In Trump's campaign, he wanted to bring it all the way down to 15%. That would basically match China and be one of the lowest in the world. Probably didn't have that much support for that from within the Republican Party, so they've reached a compromise at 20%. It's still below the average for the industrialized world, which is about 22.5%. And this probably will increase tax revenues over medium term. And they've done this over the last few years in the UK. Their business tax used to be 28%. They then reduced it down to 26, down to 24. Then they've been reducing it by about 1% per year. It's down to 20% this year, and the target is 17%. And you can see on this chart that in 2009, basically they started doing this. In 2009, you can see the tax rate staying the same. but they tax revenues increased for about 3 years, even though in the final year the tax was lowered to 26%. I believe this was because the UK was coming out of the recession, the economy was getting started up again, so tax revenues were increasing. But then as we see the tax rates start to come down through 24%, 23% down and downwards, we see a decrease in tax revenues because the reduction in tax rates kicked in, okay? And so tax revenues decreased. But then, take a look at this. About 5 years after they started decreasing the tax rates, we start to see an increase in tax revenues. And now that the rate is 20%, we can see the UK is bringing in £49 billion a year in business tax revenue, which is actually $6 billion more than the previous peak in 2011 of $43 billion. So despite the fact that the business tax has been lowered, the amount of tax revenue that they're bringing in has increased quite substantially. And this is basically because when you lower taxes, you create a better environment for companies to do business in. And companies that would, be locating in foreign countries, they decide to move back to the US. More new companies are able to start because they feel it's a more favorable environment, and it just facilitates the better growth of business, and thus there's more productivity, more money is created, more wealth is created in the economy, and so even if you're taxing at a lower rate, you still get more tax revenue. But it takes a few years for this process to start, and judging by the example in the UK, it'll probably take maybe about 5 years to see increases. There probably will be a decrease in revenue in the first 2 or 3 years. So what do I think about all this? Well, I think that the tax plan is reasonably strong, and it's going to be reasonably beneficial to most people, I would say. There has been a bit of compromise, obviously, in what Trump wanted to do. Notably, the business rate is not going to be 15%, it's going to be 20%, and they don't have the walls to go all the way down to 15. Just kidding there. With the personal rates, I think that on the lower end, although the poor aren't really getting much of a tax reduction, Investopedia worked out they'll be paying approximately 0.5% less tax, which is, it's really peanuts. But to be honest, the situation of low-income earners in the US is already pretty good, with all those deductions, and as long as they put their head into working and finding out about all the programs that they are actually able to get, like Medicaid and all the kind of social programs that give you a bit extra cash for low earners. I'm not a big supporter of socialism, but hey, I'm just telling you what's out there, Medicaid, certain welfare benefits, all that kind of stuff. WIC, which is food checks for like pregnant women and for young babies, which gives them free food, certain staple foods, all that kind of stuff's out there for the low income side of things. So I think they're in a reasonably good position in this country. I would have liked to have seen a bit more of a reduction for the sort of upper middle class, people earning more than $75,000 a year, sort of in the 100,000 range. They're basically going to be taxed at 25%, which is the same as before. I think it would have supplied a bit more of an incentive to sort of move up, through the income levels from, earning 75 or so up to around 100,000 a year, which is definitely a good place to be. And then obviously for the rich, they're getting some quite large tax cuts. Certainly if you're earning over 416,000, you're going to be getting a big tax cut on everything you're earning above that. And that's going to add up to tens of thousands, even hundred thousands of dollars for certain people who are getting salaried income taxed at that level. In reality, though, people who are earning over 416,000 a year, or people who are earning several million a year, they're normally not getting that as a salary paid to them by some company. They're normally owners of small companies or part owners of big corporations with shares, and they're getting that income as dividends. So if they've held those shares long-term, like more than a year, that's going to be taxed at the standard long-term capital gains rate of 20%, even lower than an LLC small business owner. So there's no change there. That's going to still stay the same. So definitely rich people on salaried income are going to be getting a very big tax cut. I don't mind, I don't care, to be honest. I think I would have to get to that level of income and see what it's like up there before I really can make a correct judgment on whether, oh, we've got so much money, I don't mind contributing a bit more, or, oh, now that I'm rich, I've got a massive house, I've got a Ferrari, I've got this, that, and that all are very expensive, my whole family expects this, expensive lifestyle provided by me. the tax cut would be very welcome. It might be the case, you know, I don't really know. I don't want to make a judgment about something that I'm not, you know, experiencing personally, because I'm more around the average income, perhaps next year a little bit higher than that, but you know, still reasonably average. So guys, what do you think about Trump's tax plan? This has been a very long video and it's a very complicated topic. I'm just introducing the kind of key points. Thanks to everyone who bought the wallets that we were selling. We actually sold out within the first day, so I think there may be one version of the Traveler left if anyone wants to buy that. It may already be sold out by now, but you can check. I'll put the link down below. We will definitely be getting another batch in, and we'll put a video up when they come in, so people who missed out yesterday or the day before will be able to get their wallets next time. We'll get bigger batch as well. And just thanks to everyone who bought them. I saw addresses from all over the country, from Texas to California, Washington State, Washington DC, where else? North Carolina, Virginia, Georgia, right here in Brooklyn. Well, not here, but you know, just across the river over in Brooklyn. So all over the country. So it was really cool to see that and see where all our fans are from and stuff. So thanks very much, guys, and I hope that your wallets arrived on time. So thanks very much, guys. Give this video a like. Please subscribe if you're new, and we'll see you next time. Bye.